Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will update us on currencies, oil, and the markets. InsideTrack.com President Eric Hadik discusses whether there's a connection between hurricanes, war, and the markets. Is it a case of those who forget history are doomed to repeat it? WolfStreet.com publisher Wolf Richter updates us on the U.S. real estate market, and will their push to higher prices continue? We'll talk to Ross Clark right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross.
Always a pleasure, Jim.
The Canadian dollar has fallen below 80 cents U.S. What's happening in the currencies market?
It has been quite the run this last 6 months or so. We had two good waves of buying. The first one took us up into July. The second one started off decently in August, and then Bank of Canada decided they were going to bump rates faster than people anticipated. So you had that 1 day real big pop from the about a cent and a half rally, and then it started to roll over. And of note here in the last 2 weeks, as the other markets started to come to life, and we take a look at the commodity markets relative to the Canadian dollar, you ended up with this really nice move in crude oil, pushed through from that $46 bottom that it put in the summer, managed to push through 50 and up to 52, and the Canadian dollar didn't participate at all. And whenever we see these types of divergences with Canadian dollar failing to move against oil or the CRB, the Commodity Research Bureau Index, that is just a big, big red flag. And on top of that, the commitment of traders numbers, and this is just not just a measurement of sentiment. This is the actual money that people are putting in place in terms of the positions that they have on regarding the currency. Those not only had extreme levels a couple of weeks ago, but even as of this week, when the dollar has started to roll over, we see that the commercials have even added more to their short positions, and the specs are buying the break. So this is clearly a market that looks as though it may be short-term oversold, because we have had about 10 days, 2 weeks of a break, maybe a 2-cent drop. Might get a little bit of a bounce, but overall, probability is that we should be working our way maybe towards the 77-cent level in the next month or two. And the other side of the coin is that the U.S. dollar has also made its reversal, and it had just extremes on its commercial positions as well. So we're probably into more of a chattering consolidation phase, giving back some of the moves that we had in the spring, pretty much across the board, whether it's U.S. dollar, Canadian dollar, even the euro, that type of thing is what we want to be looking at.
Gold has dropped below $1,300. Was that unexpected?
Well, here's another one that got really overbought, had lots of good bullish news in it, better part of a month ago now, and the spec and commercial positions got way overdone. And I think the fact that it couldn't rally once again when it was given enough news regarding, the U.S. deficits and the situation with North Korea, all those items that you tend to get the quick little pops on, the fact that there's no follow-through on it, this probably takes the better part of another month or so before we've had a decent enough clean-out and probably correct back quite a bit deeper than we're looking at right now. Don't forget, the positive seasonal for gold and silver doesn't really start until you get into December, January. We've been basing out in that December time frame in the most recent years. So I think you want to be looking for just overhead resistance here for now.
It's the end of the quarter. How have the markets reacted to that?
Markets had, the S&P, once again, new record highs to close off the quarter. Good strong movement also in the Dow. The small caps, the Russell 2000 has had just an exceptional month, on the upside. And we've been seeing rotation in the market. So as to say, the small caps have come to life. The financials in particular, the banks, have done very well. Now, seasonally, you would expect the banks, especially in Canada, to do well through October and before they start to report in the first part of November. Now, to finish off September at a new all-time high, when we go back and look, typically what would happen is that you would see a setback in the next couple of weeks from here. There's been a lot of money managers that would be trying to make their books look good for the end of the quarter because these are the numbers they have to show in terms of their holdings. So we look for some unwinding of the move that we had this last week or so. When we look at the bigger picture, there's a major support line coming up when we look at the currency-adjusted S&P, and that September low that we put in is something that is going to need to hold to keep this bull market in place.
Ross, thank you so much for chatting with us.
We'll be with you next week, Jim.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for him, you can email him at ross.clark@cibc.ca. Coming up, Inside Track President Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik. He's the CEO of InsideTrack.com. Welcome back to the show, Eric.
Well, thanks for having me back, Jim.
Gold is making some moves. You believe what's happening short-term, mid-term, long-term, and what do you believe where we are or where we might be in the cycles that involve gold?
Well, I think gold is having a very normal and something in the context of a stronger trend type of correction. When we rallied into early September, gold got right back up to the 1 to 2 year resistance levels that were identified last year, and that ended up containing the rally in mid-2016. And again, this latest rally, it continued or contained once again. But as I said, I think that this has the potential to be a very constructive correction in gold and in gold, even in gold stocks, as long as one key indicator does not turn down in the coming weeks. And the reason I say that is a lot of times when you get a trend confirmed or initially confirmed, as we've seen in gold in the last couple months, then you'll get a normal correction, and the weekly trend indicator that I use will attempt to turn down. but will fail at doing so. And that failure is conversely one of the more powerful signals that my technical work can generate, because it basically shows that the market has corrected as far as it can go without changing the trend. And that's kind of what you want to see for a good solid correction, and it's what you want to see for the ideal buying opportunity, where the market has pulled back as far as it could go, but not done enough damage to the 3 to 6 month and 6 to 12 month uptrend. So gold is in that type of formation. I was looking for a quick sharp drop from September 8th or 11th into the 21st, 22nd as the first stage. We got that, and to begin this week, we saw a little bit of a rally, went right up to weekly resistance, and I'm looking for another downturn that could stretch into early October. There are already some target levels set up there, but it's really this trend indicator that's going to be the key to me. And as long as gold does what I'm expecting it to do, pulls back farther but does not reverse the 3 to 6 month trend, that's going to be where I think it's time to start looking more seriously at gold to the upside.
I'm wondering why gold hasn't moved faster and higher with all this war talk with North Korea. Why is that a factor, or it's just part of the natural cycle out there?
I have fielded that question, or very similar ones, many times before, and really the quick synopsis of my conclusion to that is in watching gold and versus the dollar versus inflation versus geopolitical upheaval over the last 30 plus years, the most consistent correlation I've seen is when there is serious problems with one of the primary fiat currencies. Normally it's the dollar, when the dollar's breaking below key levels, not just declining, because a normal decline, kind of like I was just talking about gold in this corrective mode, normal ebb and flow of the market isn't enough to really panic people into gold. But when the dollar, or in recent years when the euro was kind of the focus of traders' attention for a while there, when one of those fiat currencies is breaking below some key levels or accelerating to the downside, in one form or another, it's showing more of an extreme negative movement, that's when you see the money flowing into gold. The expected correlation to geopolitical upheaval and war talk, like you said, it's a very inconsistent one. And I think that you got a little bit of a pop in gold during the first one or two interactions between Trump and Kim Jong-un. But after that, it became more of white noise, and I think that the market kind of then gets inoculated to that level of challenges, and it's looking for something worse or more extreme before you're really going to see movement into gold. And conversely, over the last couple of weeks, you've seen the dollar, after being in a 6-month or 8-month decline, it started showing some signs of stability right in the beginning of September. And even though it hadn't yet begun to rebound, it was stemming the acceleration to the downside. And that's often all it takes to quickly sap that safe haven premium out of markets like gold. So it's not even when, a lot of times traders are looking for, okay, if the dollar really rallies strong here, then gold should drop. That's not even the case. Money was starting to move into gold as the dollar declined for that 8 months. But as soon as you see any sign of that decline moderating or flattening out and going into a consolidation period, the safe haven premium just evaporates. And then you're left with whatever other bullish factors there are influencing the metals, but you see that premium just, like I said, disappear in days sometimes. And I think that's what you've seen in gold in the last couple of weeks. And I think there still is some more downside. There are some pretty convincing daily and weekly cycles coming into play in a couple of weeks from now. And if things really set up the way I expect, that would be the ideal kind of price and time convergence there. And maybe that's a lot of times the markets kind of give you clues as to when you're going to see some of that geopolitical upheaval or ramping it up to the next level. The way several of the markets are setting up, it wouldn't surprise me if sometime a little bit later in the fourth quarter of the year, we do see something more flare up, whether it's North Korea, whether it's something in the Middle East, whether it's somewhere else, but something else that unnerves the market.
Eric, in the war cycle that you've talked about previously, where are we and how dangerous is it?
Well, the really longer term, cycle that I have been kind of most focused on has to do with this 40-year cycle in America and around the globe. But even the second multiple of that, the 80-year cycle that has timed major wars and particularly America's entry into those major wars during the last couple phases of that 80-year cycle. And for me, that focuses on 2021 as really the culmination of those cycles. But that 80-year cycle, I've documented it back hundreds of years, and even in the early stages of the colonies and North America being explored, you had major wars in Europe and even partially spurring some of the movement to America, but in the 1610s, then in the 1690s with the King William's War, then the 1770s, and that was where this 80-year cycle began to get a bit more specific with America and with its more precise, where 1781 was really the culmination of the Revolutionary War, where America was concerned, and Battle of Yorktown, surrender at Yorktown, and then it was exactly 80 years later that America was diving headfirst into the Civil War in 1861, and precisely 80 years later that America was entering World War II in 1941, and I'm looking at that 80-year point in 2021 as being really the strongest convergence of these cycles. But in each case, there has been a buildup leading into that time frame, whether you talk about the Revolutionary War and even leading up to the Civil War, starting with Bloody Kansas and some of the other battles starting in 1855 and leading up to 1861, and the battles in Europe and Asia in the leading up to the Second World War. So you always see those the early stages of it. It's not like the war just comes out of nowhere. And so what you're seeing with North Korea, and whether that, if that ended up being one of those things and started to pull Asia into it, I'm still looking at Middle East cycles that just kind of hit an inflection point in this month, September of 2017, and it identifies the year, in this case, the Jewish year, since we're talking about the Middle East, from September 2017 to September 2018 is just a uncanny convergence of cycles related to wars in the Middle East and related to Jerusalem, which it's interesting that all of a sudden you start in recent months, and even since the inauguration, you start getting talk about the U.S. Again saying it's going to move its embassy to Jerusalem, and then the rest of the Middle East basically saying that them's fighting words. And so even though all the focus is on North Korea right now. I'm keeping just as close an eye on slowly smoldering and developing events in the Middle East, and even a couple other potential areas around the globe.
We'll have more with Eric Hadik next on This Week in Money.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik. He's the CEO and president of InsideTrack.com. Eric, going back to the cycles of war and how they might affect the economy, is that 80-year cycle that you were just talking about previously, is that kind of generational? People have lived long enough, generations have died off, they've forgotten what war's really like, and they get all keen about it again? Do you have any reason why these cycles happen?
I certainly think that is one of the factors in there. Those that forget the lessons of the past are doomed to repeat them. Well, sometimes that becomes a national amnesia that sets in after one generation is fading and a new generation coming to the forefront. So I definitely think that's one of the facets to that unique cycle. I think it's even interesting to me that going back to the origin of that 80-year cycle, the 40-year cycle, very interesting to me that with all of the different applications of that cycle throughout history, you even go back to ancient times and in old manuscripts and throughout the Old Testament, the Bible, you hear the 40-year cycle just repeatedly when it's talking about many historic things, when it's talking about the life of Israel and just recurring 40-year cycles of peace, 40-year cycles of war, 40-year cycles at battle with the Philistines, and then 40-year cycles of peace. And it just keeps going and going and going. You look at the peak of their prosperity was a trio of 3 40-year cycles. The reign of King Saul for 40 years, the reign of King David for 40 years, the reign of King Solomon for 40 years. And one of them was King David's reign was a lot of war, and then Solomon's was a lot of prosperity and peace. And at the culmination of that 40 years, the nation began this tearing apart, basically. And there's many applications of that. There's many examples of that throughout the last 3,000 years. It's not just that period in time. And so it's something that you certainly have to look at anecdotally and say, okay, this thing just keeps recurring over and over and over again. There must be something to it. And lo and behold, in recent years, and I've talked a lot about how I've seen climate and earth disturbance and food crisis cycles linked to the same 40-year cycle. In more recent years, I've also heard where they've identified the sun, really the main cycle of solar storms is what they call the Great Conveyor Belt on the sun, and it's a 40-year cycle, and it governs the ebb and flow of solar storms and when we've got these X-class flares, and coronal mass ejections and geomagnetic waves, targeted at Earth and the impact that they have on just the overall stability and psyche of those on Earth. So there certainly is a natural correlation there and a confirmation of a cycle that's been observed for thousands of years, and more recently we've had the know-how to identify at least one of the triggers or the origins or the links of that cycle. So I think that there is certainly a human psychological perspective, like you pointed out, and a generational one. And I also think that there is a natural one that governs our lives.
When we have these huge solar flares, does that mean that our crops are affected as well?
Well, first of all, not just one or two, and even when you have your times of greater number of sunspots in a given year, the ebb and flow of that cycle, which is an approximate 11-year cycle, and then there's a second multiple of that cycle, just like we were talking about the 40 and the 80-year cycle and how they're linked. There's an 11-year and about a 22-year cycle, because each of the 11-year cycles, the polarity of the sun and the solar storms on it shifts from north to south and then back to the other over a 22-year period. So there's an initial cycle and then an overriding one that times more significant events on that approximate 22-year basis. It certainly has some impact on climate, but I don't think that you can really pinpoint an isolated, here's a big solar storm and here's all of a sudden problems with crops. It's more the synergy of a lot of these things that I look for, and it's even why I've said that I thought from 2017 to 2019 we'd see an intensification of several of these things, because I thought that, well, there are some sunspot solar storm cycles that look to me like they should accelerate into 2019. There are some even volcanic cycles that I'm looking at 2019. And there's food and crop crisis cycles that, to me, enter a crescendo over the next 1 to 2 years, and we could see some related events. So it's the synergy of all of these things coming together in the final years of the decade that has had my focus for the last 8 to 10 years. I've also talked about some uncanny cycles of unity in Europe and in the Middle East. Even though they're two distinct cycles, they're both coming together in 2018 to 2021. And so that even kind of has me contemplating some of the possible scenarios if that's going to come to fruition, and I'm talking about a kind of a reunification where Europe's concerned, and another attempt at and maybe finally a successful Middle East union, as has been attempted multiple times over the last century. So it's the synergy of them all that has my attention more than an isolated one. But I would say that it was very intriguing to me that in September, just when you're entering this, these Middle East cycles that I'm looking at, just when you're entering some climate and solar, the very early stages of those cycles, you had first you had the total solar eclipse go across North America, and then after a long period of pretty much relative dormancy on the sun, a week or two later, you had a couple of major solar storms, solar explosions, and some of these X-class flares, which is the higher, you've got, I think it's G, M, and X, if I recall correctly. Some of the strongest ones heading right towards Earth, and you often see the northern lights, the aurora borealis, spread much farther south when you get those CMEs hitting Earth. And all of that was just as we were having this progression of major hurricanes. So whether there is a direct link or not, I don't have I'm not in the pay grade of those type of fields of study to really definitively say that. But my contention all along has been that a lot of these cycles, too often I think people get caught up in looking for a cause and effect between two corresponding cycles. And to me, my contention is that there's some much bigger cause, and then all of these different things are effects or results of that major event or cycle. So even though they're happening together, it doesn't mean that one's causing the other. More likely than not, they're all the result or the effect of a much bigger cause that these cycles are measuring and governing.
Eric, do you feel the cycles will cause even more major hurricanes this year?
I don't. With cycles like that, they're not precise enough to really hone it down to that specific of an analysis. So I would have no basis on which to conclude that or the inverse of that. A little broader perspective, I started talking in last year that my cycles I watch of drought and flood, I expected to go through a dramatic shift in 2016, 2017 away from the just complete drought cycles all over and into some serious flooding cycles. And you saw that pretty quickly validated in South America and California over this past winter. And then you have seen it in multiple places around the globe throughout this year. And even back in my April Inside Track, I detailed some of the climate cycles I look at, and in fact, the title of that issue was Deluge and Drainage, talking about why I thought we were going to see a significant increase in flood events, and ultimately the topsoil erosion that they have been known to cause in the past, and that's a factor that sometimes takes a couple of years to really recognize the impact of, and that's just one of those impacts. But the bottom line was that 2017 was the year when I thought we'd see this shift into much more flooding events, and these hurricanes have certainly also helped validate that bigger, broader cycle. But again, getting back to your original question, I really couldn't tell you and wouldn't even attempt to draw a conclusion as to whether that's going to impact the next month or so in the hurricane season.
Is it true over the last couple of decades we've been losing about 1% of our topsoil a year, and that could really boost the price of food?
One of the articles that I read a couple years ago or a year ago, it didn't break it down into the year by year that you're mentioning, but it was saying that, and showed some of the documentation of it, that over it caught my eye too because it was a 40-year cycle that this author mentioned, and it detailed where over the last 40 years the Earth has lost a third of its arable land, and certainly topsoil erosion is one of the factors going into that. There's a lot of other factors, whether all the way to things like livestock grazing, and many other additional factors. But it does seem to be it's pretty clear that it's a festering challenge that, like so many of these problems, they kind of stay below everyone's radar as they get worse and worse and worse. And it's only when that proverbial straw breaks the camel's back, that then everyone takes notice, and then we'll get politicians involved wanting to pass legislation left and right that does little but address, the most recent symptom rather than dealing with the problem itself. But it's very intriguing to me that when you go back 150 years and you look at some of these climate swings and these food and crop crisis cycles, that after the fact, when historians were looking back at some of those, they kind of showed this link between topsoil erosion and what I'm talking specifically about is this 40-year cycle. You had one of the first big major droughts in America as a nation, in the late 1850s to early 1860s, afterwards termed the Civil War drought. And then in the 1870s, 20 years later, they had another one, and then in the 1890s. So 3 of them in this 140-year cycle. But there were some writings, historian accounts of that, that were showing how even then that the loss of a lot of the prairie grasses across the Midwest and from livestock grazing even way back then were creating a problem. And then 40 years later, after the 1890s, after that first 40-year cycle, then you had the 1930s and the Dust Bowl, and much of that was linked to the depletion of topsoil. And so and then lo and behold, we jumped to the 1970s, and here in America, that's when all of a sudden we shifted to this fence row to fence row planting of corn and creating all these monocultures, which have their own long-term detrimental impact on topsoil and on just on degradation of the soil in general. And so here we are in the next phase of that 40-year cycle. It certainly wouldn't surprise me to see the next phase of that continuing challenge that has to do with agriculture and crop raising.
Eric, thank you so much for being on This Week in Money.
Thanks for having me, Jim. It's been my pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrack.com. Coming up, Wolf Richter next on This Week in Money.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Well, thank you, Jim, for having me on your show.
How are the various U.S. real estate markets doing, and is California, as usual, the trendsetter?
Our housing markets are, as they always are, very local, and so we have some cities where we have enormous housing bubbles, and we have other places maybe where the housing bubbles aren't that extreme, but in California, it's particularly extreme. So depending on what real estate data you look at, it's always a little different. I mean, the data don't always show the same thing, but in this case, we're looking at the Case-Shiller home price indices for the United States and for each individual city. And for the United States, we're now about 5% above the crazy peak of the prior housing bubble, I call housing bubble 1, that ended in a total collapse of home prices and the banking system in 2007, 2008, 2009. So now we're 5% above that. And interestingly, at the end of housing bubble 1, after it started imploding and is already down 10, 20, 30%, everybody called it a housing bubble, and everybody said, yeah, it wasn't sustainable, it needed to blow up. And this language is now sort of disappearing. And because in so many markets we're now above this crazy peak of the prior housing bubble. And so now this crazy peak of the prior housing bubble is considered sort of the serene state of calm that has become the new base. And so we can grow from that point on. And when you look at the charts that I posted on my website, it is just ridiculous how these markets have performed. And so anyway, in the United States, we're up overall 5% from the peak of the prior housing bubble. That was a 6-year ride up there. Values increased by about 45, 50% over the time period, which is huge considering that wage gains are in the 2 to 3% range per year. So, there is no way for labor to keep up with the rising home prices. In different cities, it looks differently. In Boston, for example, we're 13% above the prior peak. In Seattle, which is closer to climate in terms of weather and the way the housing bubble works, to Vancouver maybe, we're now 20% above the prior bubble. And if you look at the prior bubble, it's just insane. And this one is even more insane. So it's starting to match what you have in Canada, except you never really had a housing bust, like we did in California, or in the United States. So in your situation, there was a little dip for a few quarters, and then the housing bubble just continued. In our case, we had a huge plunge, and now we have these soaring home prices. There are two markets where housing bubble 1 wasn't actually very well developed. That's Denver and Dallas. They now have both soared. Denver is now 44% above the prior peak, and Dallas is 41% above the prior peak. If you look at the charts, it's just pure insanity. You cannot. Homes are treated as a global asset class, but in fact, homes are not an asset. They're a place where people live. And once you start treating them as an asset class, you get all kinds of distortions because, there's an infinite supply of leveraged investors and there's not an infinite supply of homes. So when you convert a home to an asset class, you get these gigantic price movements that then can no longer be justified by the incomes of the people that have to live there. So housing bubbles eventually implode simply because the actual demand for housing starts disappearing when wages no longer suffice to pay for it. And then you only have investors, and investors selling their homes to each other, and at some point investors see this too, and they're trying to unload the houses, and that's when our prior housing bubble collapsed. And we're going to look at a similar scenario here. In Portland, for example, the current housing bubble is 20% above the prior one. In San Francisco, we're now 27% above the prior one. San Francisco, in the whole Bay Area in general, the median prices in 4 Bay Area counties are now over $1.2 million per home. And in San Francisco, 1.2 million, that's a median home. That's a condo. That's a 2-bedroom condo, and not even a fancy one. So it becomes completely unaffordable for a large part of the population, and so eventually the demand will wither. We had some data come out for August in San Francisco. 402 homes were sold in San Francisco that month. That was 29% below home sales in 2012 and 25% below home sales in August 2013. So volume is getting crushed. We in the whole Bay Area, pending home sales have started to collapse in the last few months. They're down year over year for the past 11 months. So volume is getting really hit hard because a lot of people simply cannot afford these homes. The story in the media is that there's a lack of supply. There's no lack of supply. What there is a lack of affordable supply, and there really is a lack of demand for high dollar homes. The house next to me is just down the street a little bit. It's been on the market for 12 months roughly. They have cut the price twice, and they pulled it twice, and they pulled it again in July after not selling. They slashed the price by $1 million over those two times. So these price cuts are showing up everywhere, and the higher end, and the sales are not there. In the lower end, people are buying things, but in the higher end, it's just really tough. And so we see these problems crop up beneath the surface. That volume is slowing down. There's still demand. There's a lot of investor demand at the higher end. You know, people are leery of buying. At the lower end, people can't afford it. So in the Bay Area, this is we're looking probably at the latter part of this year. We're looking at a fairly strong downward trend in terms of sales. Now, pending home sales aren't always a good indicator for the future, but we had such a strong move for so long that now this is starting to play out, and so I think the Bay Area has gone as far as it's going to go. In San Francisco, home prices have already sort of flattened out a little bit in terms of the median price of the last couple of years. The Case-Shiller index still shows it's spiking, and those are the differences we see in the different data sets, and we have trouble reconciling those. But they're starting to be issues beneath the surface. In other housing markets in the United States, we don't really see that yet. Of course, we've had a lot of hurricane damage in the South, so in Texas and in Florida. Florida got hit particularly hard in terms of housing. So this is going to really hit the numbers. In other places, in New York City, we've already seen some problems in the condo sales. Miami, before the hurricanes hit, had problems in its condo market. Now, all bets are off. Some parts of Miami where the condos all got flooded, and even though the condos, the high-rise buildings did okay, but the streets were flooded. And so I don't know what that will do. We'll just have to wait for a few months. Other cities are not nearly as high priced. If you go to Southern California, for example, prices are lower than in the Bay Area, but they have been spiking recently, and they spiked during the last housing bubble 1. LA home prices increased by 160% over the course of 6 years, and then collapsed by about 2/3 of that. And then now they're back up, and they're almost back where they were. And if you look at the chart, it's like you're somewhere in the mountains in a very steep valley, looking at these gigantically steep mountains to both sides. I mean, it's just ludicrous the way this chart looks. And at the same time, that's the reality in Southern California right now. In New York home prices overall, this is so varied, but I like to look at condo prices, and they have they grew 130% in 5 years before the first housing bubble burst. Now they've grown substantially more. They're up 20% of the prior peak. There's a lot of issues in the New York condo market right now, especially at the high end. As you might know, we have the United States government has instituted money laundering investigations, and this has hit in some of those markets. So New York, San Francisco, Miami, and some others. And this has hit the demand from foreign buyers quite a bit. So Manhattan is struggling with that right now. So overall, nationwide, I think the home prices are going to continue, on average, are going to continue to rise for a while longer. But in some of the in some of the bubbliest markets, I think we'll see some changes here in the next quarter or two.
Wolf, are they easing up mortgage restrictions in the U.S.?
Yes, they are. And I've kind of touched on that. The volumes are going down in some markets, and so the demand for mortgages has dropped. Now, a lot of homes are being bought by investors. A record amount of homes are being bought by investors, and they don't use mortgages in that sense. They often use institutional debt. So they buy homes and they borrow at the institutional level. And so you don't see it as a mortgage. But the individual mortgages, the purchase mortgages, the demand for them is down. And so mortgage bankers, and that includes banks and includes non-banks like Quicken Loans and others, they're worried about slowing demand. There's a lot of competition in the market, so they're griping about the competition. And we know that because Fannie Mae does a loan officer survey among the Fannie Mae approved lenders, and it publishes the survey on a quarterly basis. And so we know that they're worried about demand, they're worried about competition, and they're responding by lowering the mortgage standards. And part of that comes from our government-sponsored enterprises that guarantee those mortgages, because they've also lowered their standards a little bit. And so the whole industry is trying to figure out how to keep this alive somehow. And now that prices are so high that regular people have trouble affording these homes, where do you go? And so one of the things that you do is you lower mortgage standards. And this is ironic, because our interest rates, our mortgage rates are near historic lows. And despite the Fed raising rates, they have remained at near historic lows. Rates have not come up much, and they're still below 4% for fixed rate 30-year mortgage. And if demand for mortgages are down at these low rates, what will happen when interest rates rise? And that's, I think, the big fear that we now have.
Is the Fed likely to continue hiking rates?
The Fed's doing two things. And it's right. It has been hiking rates, but very slowly. And so we've had now our fourth rate hike since it started, and which is very small amounts, very far apart. But it also announced at the last meeting, it announced that it will unwind QE, so it will roll off the assets that it had acquired during quantitative easing. And this is potentially the bigger thing. So there is some dispute among Fed heads about raising rates, because inflation is low, relatively low. It's below the Fed's target, and even though people in their personal life see quite a bit of inflation, but by the Fed's measure, it's below its target. And so there are a lot of people that say, why raise rates at all? And I think the Fed should have raised rates a long time ago, and it should raise rates now. But there are a lot of people saying, no, they shouldn't. And the Fed, Yellen and other Fed heads that are important are brushing off the low inflation. Time after time they get challenged on it and they brush it off and they say, well, it's going to go up, it's not that important. What they're looking at are asset prices. They're looking at home prices, they're looking at commercial real estate prices, they're looking at the exposure that the banks have to these inflated asset prices, and they're getting really worried. And that's what in my opinion, that's what they're doing. They're raising rates not to tamp down on inflation. They're raising rates to tamp down on asset price inflation. So we have consumer price inflation that's relatively low. We have asset price inflation that is insane, where many assets have doubled, including commercial real estate. Many assets have doubled in price over the past few years. And banks are exposed. Commercial real estate there's $4 trillion in loans backed by commercial real estate. Much of that is it's on the books of smaller regional banks that are very much threatened by a major price change in commercial real estate. So the Fed is very focused on asset prices right now. And that also, and so we had some dissensions at the last rate hike, and now the more Fed heads saying that we don't want another Fed rate hike, and the majority still thinks we're going to get another rate hike. So I think in December we'll get one. But the decision to unwind QE starting October 1st was unanimous. And so there's a consensus in the Fed that it's time to unwind QE. And that's unrelated to inflation. It's unrelated to what they think the economy is doing. I think this is strictly focused on asset prices. And what that will do is it will push up long-term interest rates. Now, the Fed raises short-term rates, and it doesn't really manipulate long-term rates. And the only way it can do that, or it can try to do that, is by selling long-term bonds that it has on its balance sheet, including mortgage-backed securities. And that is expected to bring up long-term rates, which will make mortgages more expensive, which will make commercial real estate loans more expensive, and so forth, and which will tamp down on the enthusiasm. So there was unanimous support for that in the Fed. Now, we've got another thing going on here. We don't know if Fed Chair Janet Yellen is going to be reappointed next year. Vice Chair Fisher has already resigned. He's leaving in October. So these are the key people on the FOMC policy setting committee. And there are several open slots. So next year we could see a complete changeover just about in some of the major figures on that committee that sets the policy rate. So we don't really know what the Fed's going to look like next summer. It's really hard to predict where they're going to go with it. But considering that the QE unwind had unanimous support, I assume that will stay. And so right now they're going in October, they're going to start unloading $10 billion in securities, and that is going to ramp up. By next year, they will unload $50 billion a month. So that's $600 billion a year in securities. This will drain $600 billion out of the markets. This will do the opposite of what QE did. QE inflated asset bubbles. Unwinding QE is going to do the opposite. Ben Bernanke called it the wealth effect. You know, the central bank buys these assets, creates money, buys these assets with them. It drives up asset prices. People get wealthier, those people that have these assets, and so they spend more, the so-called wealth effect that's supposed to help the economy. Now, when you reverse that, the reverse effects take place. And so nobody's ever done that. We don't know. We're going to be in unknown territory, but that's the plan. $600 billion a year in money will get destroyed, and the Fed creates money and it destroys money. So this is the time we're in that phase, and we have never been through this, so we don't know what's going to happen. But those are the two things the Fed is doing. One, it has unanimous support, the QE one. The other one is more controversial, but I think we're going to get another rate hike in December, and next year is just wide open. We'll just have to see what the people are that will be on the committee. We really don't know. I mean, this is wide open right now. There's a lot of uncertainty, and eventually the markets will get nervous about the uncertainty too.
Who gets to absorb the mortgage losses caused by the hurricanes?
The people that had flood insurance will get some limited amount from the federal flood insurance program. Not many people have flood insurance. A lot of people, especially in Texas, were in areas that were not in flood zones, and they didn't get flood insurance. So then the question is, who's next in line? When a house gets destroyed with a mortgage on it, and there were maybe $500,000, and it may not be destroyed, but it's damaged, then generally what happens is that the borrower, the homeowner, will first be laid on his debt and then maybe try to fix the home. If he can't, just abandon it and let the lender have the debt. These are not for recourse states. California is these are recourse states. I'm sorry. These are states where the lenders have recourse. They can go after the borrowers, but there are only 12 non-recourse states in the United States, but they're not. Florida and Texas are not among them. And so in theory, the lenders could go after the borrowers, but they're not going to do that. They're going to swallow those losses. Now the lenders, who are the lenders? some of those mortgages, many of those mortgages are guaranteed by our government-sponsored enterprises, Fannie Mae and Freddie Mac, and in that case, the taxpayer will eat the losses. Then there's another category of federally backed loans. They're backed by Ginnie Mae. Ginnie Mae is a direct subsidiary of the FHA, which is part of the Department of Housing, and it runs under different rules. So it has a requirement that the lender must keep the home in good repair. So the mortgage originator must keep the home in good repair. So the entity that services the mortgage now finds itself in a place where the house was destroyed. The mortgage that was guaranteed by Ginnie Mae now is up for dispute, and this is being discussed right now. It is very likely that these mortgage service companies that deal with these mortgages have to buy back the mortgages and of those homes that were destroyed because Ginnie Mae doesn't guarantee mortgages of destroyed homes, and in that sense, it's different from the others. And these are a lot of these lenders are smaller. I mean, they're big banks. Wells Fargo's in it pretty big, but a lot of them are smaller lenders, non-bank lenders like Quicken Loans and others. And some of the smaller ones among those could get seriously in trouble if they have to buy back large numbers of mortgages from Ginnie Mae. So this is going to be a mess. I mean, they're talking about this, and it could be that there will be a taxpayer bailout of those non-bank entities that service those mortgages. So we'll have to see this, but the losses are significant. And if there's no taxpayer bailout, we expect some smaller lenders to not be able to deal with this.
Will the hurricanes have an effect on the new or used auto markets?
Yeah, it will have an effect on both. On the new car market, it will probably have less of an effect than hoped. At first, there were big hopes that a lot of nearly new cars were destroyed and would be replaced with brand new cars. Texas got hit hard because of flooding, and Florida got hit hard because of wind damage. But wind damage isn't that bad for cars, but flooding is terrible for cars. So Texas got huge areas that were flooded, and so in terms of cars, the biggest damage happened in Texas. And but now the numbers have come down, the estimates have come down. In the larger Houston area, the latest estimate I heard was that 300,000 cars were damaged or destroyed by flooding, and that would have to be replaced. So the question is, how many of those will be replaced by used cars and how many will be replaced by new cars? And it looks like not many will be replaced by new cars. Most of them will be replaced by used cars, given that a one-year-old car is going to be replaced by another car of similar age. And there's insurance companies that are involved, and there's an uninsured vehicles, the same thing. And a lot of cars will be repaired and be put back on the road. Those cars that weren't insured, there will be no documentation that it's a flood car. They'll be out there, and it's up to the buyer to decide and figure out whether it's a flood car or not. So in this way, the hurricanes impact strongly the used car market. Now nobody trusts used cars anymore. You gotta check them and you gotta inspect them because a lot of these cars are out there. And it's okay to buy a flood car, for 25 cents on the dollar or something like that if you know it's a flood car and you're taking a risk and if it looks good and runs right, But if you buy a used car thinking it's not a flood car and you end up with a flood car, you're getting screwed. And there's a whole industry now springing up trying to accomplish precisely that. And some of the titles will have a flood stamp on it, but that can be laundered in different ways. So they'll, at the other end, they'll come out with a clean title. And, that's a scheme, that's persisted despite our ability to check title histories, such as Carfax. So every buyer needs to be careful. Every buyer, when you're buying a used car, every buyer needs to check the title history and I think we will see a lot of uncertainty in the used car market because of that. However, there is a strong need for replacement cars, used cars in those affected areas, and I think prices will go up, and and there'll be vehicles brought into that market from other parts of the United States.
Yes, and people in Vancouver who think they might be immune to flood-damaged vehicles. After Katrina, we found flood-damaged stuff here. People go to clean their car, their used car, and wonder why there was sand under the seat.
Yeah, I mean, I would be leery of any car, any used vehicle imported from the United States at this point. Do very careful research and check out the car very carefully. Now, some of the flood cars were flooded only up to the floorboards, and so mechanically they're okay. But you shouldn't pay the price of a non-flood vehicle for that car. You should get a huge discount on it. And that's the thing, you should make a conscious decision, and you should know whether it's a flood car or not. And if it's not a flood car, it's okay. And if it's a flood car, the price needs to be cut dramatically. What's not okay is if you're buying a flood car thinking it's not. You'll have problems forever, and you paid full price, and that's to be avoided at all costs.
What will happen to all the vehicles damaged by the hurricanes?
Well, right now, and I've seen some photos of the car lots where they're stored. There's hundreds of thousands of these cars, and some of them will be just salvaged, which means they'll be taken apart for parts, and those parts will also be flood damaged parts, and they'll be recycled, and so there'll be a fender, maybe and engine parts and other things that are damaged into some way by the flood, and they'll enter the salvage market. Other cars will be repaired and will enter the used car market. And those are the cars that you really have to worry about. And there may be good deals if it's disclosed and if you know what you're buying. But there may not be good deals. So, there's a whole industry now there that are going to deal with these several 100,000 cars, and it will take a while. I mean, they're cleaning them up, they're repairing them, they're selling them, the channels are opening up. They're putting the infrastructure in place even as we speak. This is happening, this is big business, and it happens after every major hurricane. So now we've had 2 hurricanes in one sitting, and so there are a lot of these cars spread around. A lot more cars than after Katrina. I mean, the Texas hurricane area is large, and it's very urban, and lots of people have more than one car, and so it has a very different impact on the car market than Katrina had.
Are car dealers still having trouble moving 2017 vehicles?
Yeah, we were hoping that there'd be more demand from the hurricane areas for new vehicles, and that doesn't seem to be the case as much anymore. And if it is, it's really only for some vehicle models. The biggest problem car makers have is with cars, not with trucks, and they're having trouble moving them. Now we heard that General Motors eliminated a third shift in its plant in Tennessee that was building crossovers. Crossovers are small utility vehicles, and they were hot. They were the hottest sector in the United States. They were what was going to save the U.S. auto industry because people were switching from cars to crossovers. And now the demand for crossovers is fizzling. And that's the real shock. And we're now seeing that the one hot segment that has pulled the car industry forward is now running into trouble, and the inventories are piling up, and GM eliminated an entire third shift. Now, that's not a layoff that lasts for a week or 2 or 5. I mean, GM announced 10,000 layoffs late last year that were temporary, for a few weeks here, for a few weeks there. And this looks like it's a permanent reduction in manufacturing capacity, actually. And so it's a very serious indication of where GM is thinking the crossover sales are going, and it actually said that it was disappointed by industry-wide crossover sales, and we've seen that in the August numbers too. The crossover sales were disappointing, And then there wouldn't be any big deal if crossovers weren't the one segment that was going to pull out the U.S. auto industry out of its funds. And auto sales are down in the United States. We're down about 320,000 cars for the year so far. So, losing one strong segment is not going to help. And 2017 cars, especially cars, they're piling up on dealer lots, and they're not moving very well. Trucks are still, pickup trucks and large SUVs are still doing okay, and the inventories are not huge. But on the car side, we're in really bad shape.
So that means vehicle manufacturers are cutting back on production for 2018?
Yeah, Ford also announced some production cuts. Now, the GM production cut to 2018 models, the Ford production cuts that it announced a week earlier, also for 2018 models. It is a response to the lack of demand. Now, Ford announced layoffs and production cuts in 5 plants, 3 of them in the United States and 2 in Mexico. They were building all cars. So at this point, crossover production at Ford has not been cut, but it has been cut at GM. So we'll see where that's going.
Is retail in the U.S. in trouble?
Retail overall is growing. It's not growing very rapidly, but it's growing. And it's growing because of online retail is really strong. Online retail is booming. And it's eating the lunch of department stores and other brick and mortar stores. For example, in the toy industry, we had another big casualty. Toys R Us, both the Canadian and the U.S. entities declared bankruptcy. 31% of the toys are sold online now. And toy sales have been increasing at about 5% a year, which is pretty robust in the United States. And 31% of it is online, and Toys R Us did not have a powerful online presence. It had a website, but it doesn't have a powerful presence to fight off Amazon and to fight off Walmart, Kmart, and all the other retailers that also sell toys. And so its sales have been declining for years, while toy sales have been rising, and while online sales have been booming. Now, Toys R Us, like many brick-and-mortar retailers in the United States, is owned by a PE firm, by a private equity firm. And they were bought out in leveraged buyout boom of 2005, 2006. And in an LBO like that, the private equity firm that buys the company loads up the company with an enormous amount of debt. And they, in the process, extract a lot of cash. So it's really an asset stripping exercise. And that is exactly what happened to Toys R Us. Before the buyout, Toys R Us was publicly traded and had a relatively small amount of debt. After the buyout, Toys R Us had $5 billion in debt, and debt service was getting very expensive. And so it couldn't invest in the strong online presence it needed to build to fight off Amazon. And due to that lack of investment, and it couldn't invest in its own stores. I mean, it was just running down the stores. And this is the private equity thing. You strip out cash, you strip out the assets, and you let the company survive as long as they can. And then you try to take them public and let the public shareholders worry about them. But they, because of the IPO market sort of closed on them a few years ago, they couldn't do that. They're now stuck with these retailers. And a number of them already went bankrupt, and others will follow. So Toys R Us is one of those casualties. This is the brick and mortar part of retail, especially the private equity owned part of brick and mortar, that is not getting killed. Even while retail is doing pretty well, and even while online retail is booming, brick and mortar retail is in real trouble in the United States. And there'll be flagship stores in the major urban areas, and there'll be nice malls that will do well. But the secondary malls they're losing tenants. The tenants go bankrupt. There's all kinds of issues with them. The zombie malls all over the place. The dead malls. Malls turn into parking lots. This is happening in the United States, and it's only on the brick and mortar side, but and then there's another issue we have in the United States, that we have way too many malls. in terms of square footage, we're way over mall. So, this should have happened long ago. There was an area that was overdeveloped, and so now there are consequences from those directions. 10 years ago, nobody really figured that online retail would be so strong, and they kept building out the malls, and at the same time, American consumers didn't do so well, so retail sales actually, they grew, but they grew by very small amounts rather than booming, as had been expected. So, brick-and-mortar retail is in a very tough situation. I call it the brick-and-mortar meltdown, because that's exactly what it is. It's been going on for a couple of years, and we'll probably have well over 10,000 major store closings this year of chain stores, and there were thousands last year. There will be more next year. In Canada, you've had a similar issue. Target declaring bankruptcy and Sears going bankrupt, and so it's a similar dynamics are playing out in Canada as well.
Are quantum computers making everything hackable?
My rule is that if it's connected to the internet, it's hackable. And that includes pacemakers, and it includes cars, and that's been demonstrated already. As early as 2015, some researchers shut down a Chrysler Jeep on the highway remotely by hacking into its system. We've seen the huge problem with Equifax. Equifax is a consumer credit bureau that collects the crown jewels of consumer data, including the Social Security number. And this data was stolen. 143 million Americans were impacted by this. Canadians were impacted by it. British people were impacted by it. So now these people whose data got stolen have to worry about identity theft. It's a huge problem. The way it was handled was really bad, but it happens all the time. Major department stores and are getting hacked into. The SEC just got hacked into, or it was announced that it got hacked into, and information got stolen for probably insider trading purposes. Medical facilities get hacked into. Companies are trying to build out the internet, so-called Internet of Things, where regular appliances are connected to the internet, such as your thermostat or your refrigerator or other devices that you have around the house, such as you can control them, your door lock. And Walmart is trying to design a delivery system that includes an automated door lock that allows a delivery person to come in to the house and deliver your groceries and stack them in the refrigerator while you're not at home. And these kinds of services rely on the Internet of Things, that everything can be controlled via the Internet. So your door lock can be controlled via the Internet. There are cameras inside your house that are connected to the Internet, so you know whether the guy from Walmart is actually delivering the stuff to the refrigerator, or whether he's traipsing around your bedroom. And in order to see this, you'll have to have cameras inside your house that are connected to the Internet. Those cameras are devices that are eminently hackable, and just like door locks. So anybody who hacks into them can see what's going on inside your house. And by hacking your door lock, anybody can just walk into your house. They can do other things with it. The possibilities are endless. Anything that's connected to the Internet is hackable. And the measures to protect these devices from hacking are really very basic. I mean, these companies are not spending money trying to make these devices secure. They're trying to sell the devices, and we spend a lot of time and effort trying to protect our computer systems. We have antivirus software, and we have firewalls, and all those things. Those devices are just sort of exposed to the world, and they probably don't get updated, and they're easy to hack into. So it is the current status. This is not the future. This is what's happening right now. It's happening all over the place. everything is going to get connected to the internet, and everything will be open to hacking. So, as a consumer, trying to protect yourself means that you probably need to be leery about putting some of those things into your life. And even though it might be a little bit less convenient, but if protection is important, the Internet of Things is a very new concept, and it will be very difficult to protect the different devices from hacking. It will be nearly impossible.
Wolf, thanks for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Wolf Richter. And thank you for listening. Any questions for the show or our guests can be sent to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.